Hello and welcome everyone to a Monday edition of Prosperity Squad. I've got, as promised, a video for you today on cars, cash financing versus getting a loan out and buying your car that way. And I've got some pros and cons for each of these options, but in the course of doing my research, what it became clear to me was that cars are just terrible investments. And I've got a few golden rules for you guys to listen to, and yeah, I hope you guys find it valuable. Please leave your feedback, invite your friends, as always, and subscribe to my YouTube channel, which is now seems to be becoming a thing. And I'll get right into it. So I hope you enjoy. So I've done a little prezi for you guys again. And here I'd like to start with tips on buying and financing a car. So don't want to get too technical too quickly because for me, the most important thing is to limit the amount of money you're using to buy this terrible investment that we call a vehicle. All right, they fall apart. They require maintenance. The value itself goes down in terms of resale value, even if there's no problem with the car, at a very incredible rate. So here's my tips, and I thought this quote was very amazing. Too many people spend money they haven't earned to buy things they don't want to impress people they don't like. And I think that's very important and reminds me of another quote I heard that said, drive the cheapest car that your ego can afford. So I think that's also both very valid points. And make sure you're thinking of limiting, especially at our age. We're not swimming in money, all right? We're trying to accumulate our savings. I mean, there doesn't need to be money going into an asset that's going to go down in value, especially if you're financing it with a loan that's going up in value all the time. That liability is getting larger and larger. And well, you're obviously paying it down, but still it's accumulating interest in a bad way. So the golden rule is cars are horrendous investments. Be practical, do the math, and think about what you actually need. Like if you really do need a four-wheel drive with a tray on it for your work, then you're going to have to get that. But make sure that you're getting one that's decent amount of years old, has good Ks on it. That you're not going to have to spend a lot of money fixing up. And don't for the love of God buy a new car. If you've learned anything from watching this video, is don't buy new. Okay, because I've done some research and new cars lose an estimated 10% of their value as soon as they're driven out from the lot. Okay, now that number is usually quoted a lot higher, and it does get a lot higher. Sometimes it's up to 30 and 40%, depending on how luxurious you get your car. But each year after that, it depreciates at 10% each year for the first 5 years. So on average, a new car will lose 60% of its value in the first 5 years, which is insane. All right, you don't want any investment that's going to lose 60% in the long term is not going to be a great buy. Another thing I would say is that I've bought every car that I've purchased subject to an independent inspection. Okay, some if you're buying a private sale, most of them will be fine with you taking it to your mechanic and then bringing it back if you don't want it, and before you pay them. But even at a car yard, when you're signing on the dotted line, you say, I'm going to sign this, provided that you give me my full refund if I take it to my mechanic and he says don't buy this. Okay, so get that independent inspection. You don't want to be buying a lemon, something with some small problems that you maybe couldn't pick up because you don't really know much about cars like me. But that's certainly very important, and it was very important for me. One of my mechanic actually took the first car that I brought to him. He was like, "This is a dud. You can do better." Had a small leak, and it wasn't too big. It wasn't big things that you could easily pick up on. It was just things that, and I did end up getting a better car because of that. So I do really recommend doing that. The third thing I'd like to say on golden rules is to know your price range, know what you want to buy, and know what you can afford and want to pay over the long period, especially if you're financing, before you go and pay for it, before you go and look to a car yard, because lots of these car salesmen, used car salesmen, and etc. are employed, retained, and promoted based on their ability to sell you up into the most expensive set of wheels that they possibly can. Okay, and And that's why it's very hard. It can get really difficult when you go to a car yard. You even know the model that you want, you know the year that you want, and they still sell you up into extra things like do you want the lifetime, the 5-year warranty, etc., etc., etc. You don't need to add all those things. All right, you're already insuring your car. It's not never worth it because they don't want to make less money. Okay, lots of the car dealers have some terrible like markup products. You want the upgraded leather seats. You want, that's more like with new cars. All right, but so just please be wary of where your price range is before you go. At the end of this video, I'll have um, a link to a website, which is the Money Smart website, which has a great tool for helping you determine the long-term cost of a car loan in a number of different scenarios. And you can do your own math, do your own modeling, and make sure you know what you can do before you go there. Before you go out and look for one, know where you're at and know what you want. So that's it. That's the next is cash financing. So why would you? I mean, there's the big choice, right? You cash finance or you get a car loan out, right? And these are the pros and cons of each. And I think that you will easily be able to weigh up which one makes more sense for you based on these things. So we'll go into cash financing first. So pros is that it's cheaper. So if you're paying cash directly out of your hand, giving it to them, that money is not going to accumulate any interest. There's no fees. It's very simple. It does encourage you to be more realistic because it narrows down the range of vehicles that you can literally afford right now. And if your range is smaller, you'll be more realistic naturally. Okay, but if you can keep yourself honest and keep yourself realistic anyway, that's not so necessarily a downside of funding it via loan. Savings takes time. So you got to build up that money. If you need your car right now, if you can't get to work, if you can't continue working at your job, you can't pick up the things that you need to be employed, then savings, potentially starting to save from day one and accumulating that money long term isn't going to work for you. But definitely you have to consider the fact that it's going to be cheaper if you can do that. But it's not always. If you're going to lose your job, it's definitely cheaper to get a loan out because you need that job and you need the money. You need the money now. Okay. Um, Cons: your cash is gone. Once you've bought the car, you leave yourself with no emergency savings potentially. If you're spending all of your money on the car, you're going to leave yourself without much wiggle room. If something comes up that you need to cover, you're going to have some problems there. So potentially making sure that you're not 100% draining yourself out is definitely a factor there. You don't want to leave yourself with no ability to have emergency cash funding. See, I've put encourages you to be more realistic in both columns, but that's definitely not a con of cash financing. I guess if the fact that you are limiting the range of vehicles that you can buy, which could be potentially considered a con there. And another thing that I've added in there is opportunity costs could be significant. So if you're selling down potentially some very valuable shareholdings that you've got, so that you have enough cash to cash finance your car, there is an opportunity cost there. You could have instead held on to your shares that you think are going to go like sky high, and you don't want to sell them at a loss. So that actually could cost you more in the long term because you've sold something very profitable for something that's going to be depreciating over time. So that's definitely a consideration, and it was definitely something I considered when I decided to finance my vehicle. So yeah, those are really the pros and the cons of cash financing, and then you'll see sort of how they compare when I go into the next section here. So car loans. There is a big deal of cons and pros here because it's sort of complicated. Pros: you're building and improving your credit history. So by taking out a loan, consistently paying off your debt, and meeting your repayments in a steady and consistent manner, you're actually showing a bank that you have some sort of financial discipline. And that will actually over time build your credit rating, and it'll give you a better credit score. So that I did do in a previous video a way that you can check your credit score online. If you've taken out a car loan, you've completely paid it off, and you've been on time for every one of your payments, you'll see that your credit history has actually improved. But you will see that it is a con. If you take out a loan and then you're delinquent at that loan, you don't make your payments. You end up having to sell the car back to the bank so that they can repay off their debt. It's not going to be great for you. Okay, you get a black mark and things like that. Um, improve liquidity. So by taking out a loan, you don't have to drain yourself completely dry of cash. Um, Certainly, you can understand that one based on the point in the other cash financing section. Um, it allows you to quickly make the purchase and save the money later. So if you are in a real rush and you know you need a vehicle, potentially your last car just broke down and you don't have anything to drive, and you know that if I don't get a car, I'm going to lose my job, and you live too far from your work to catch public transport, you're going to need that vehicle. So sometimes it can be beneficial from a time perspective just to take out a loan and wait and save the money later. So that leads into the second point, that you're forced saving. So because if you potentially you're not that disciplined, you have enough cash flow, but you're not putting away money for yourself, because every time you develop a balance, you develop like $2,000 or $3,000 in the bank, you end up taking a holiday and cashing that out, and you don't have any discipline. Then a loan might help you put aside money and get into that habit. Wow, look, I can actually put aside a lot of money because I've been able to keep up this credit loan. And from a psychological perspective, it could assist you in knowing what you're capable of. But that's not saying that if you have very poor financial discipline that the best thing for you is take out a loan, because that's not necessarily true either. If you've got a credit card as well, you're putting yourself into stress. That's not a good situation to be in. And there's tools for checking, what's going to be doable for you. If you go onto the Money Smart website, you can do your budgets online and just see what you could realistically afford. If you've got a lot of rent, you've got a lot of regular bills coming out, it potentially isn't the greatest idea. The last one I would say is that interests could be deductible. I put a little star here because this is very subject to what you're doing. If you're running your own business that requires you to use your car consistently on a day-to-day basis, the interest that you're paying on taking out the loan could be deductible, and there's a potential chance that the total cost of that is reduced. It's not necessarily a pro of taking out a car loan. It just makes the cost less for you than it would be for anyone else who couldn't claim as deductible. I wouldn't say, definitely seek financial advice before you go and think that you can start claiming all your interest payments, because sometimes the ATO will say, you know what, you can't actually do that, and they'll come back and they'll reclaim that money in hindsight. So it's not necessarily always the greatest move. Cons. So we'll go into this in a second. We'll go have a look at the calculator, but financing your car with debt is always going to be more expensive. You've got fees, you've got the interest that you're paying, and you end up paying a lot, a little bit more, a lot or a little, depending on, it's more about perspective. Okay, so it is more expensive. It's legitimately more expensive to buy a vehicle using debt, and it will cost you more in the long run. So the next, and it should never be done, even if you're borrowing money from your family, having to pay them back later. It should never be done without comprehensive car insurance. In fact, if you're financing through a bank or a car dealer, which I would recommend not financing through a car dealer, by the way, then if you don't have comprehensive car insurance and you get into an accident, not even your fault, you lose your vehicle, then you'll still have to pay back the debt, which really puts you in a really bad position, because not only do you have a black mark, not a black mark on your credit, but you've already taken out debt, and then you don't have the car to secure it against anymore. So there's no way to instantly pay off the loan, and you're still paying it, which makes getting a new loan for a new car more difficult. And many secured car loans will actually have early repayment conditions, which we'll go into in a sec. So if you're finding that you need to pay off that loan straight away, you can't just get out a new loan, pay off the old loan, and you'll be penalized by a lot. You'll end up having to pay the full term of the interest like straight away, which ends up being very expensive. Um, Another con that I would say is that if you aren't very secure in your employment and you don't know that you're going to be able to have a job in the next year and 6 months, then getting a vehicle is not going to be very great. Unless your repayments are low enough that you could still satisfy the repayments on New Start or Centrelink payments, it's going to make things more difficult for you. If you know that you don't have a marketable skill, like you don't have a trade or you don't have an occupation that you could quickly pick up a new job, it could get difficult for you. You end up unemployed, having fixed repayments. Potentially, you're also paying rent. Potentially, you're also paying a mortgage. Um, don't get a mortgage if you've got low job security as well. But yeah, that's definitely something you should take into consideration. You're not sure where you're going to be working in a year, or if you're going to have a job in a year, then that's potentially something you should definitely consider. So what I was going into before, the next one's early repayment conditions. So many secured loans, especially for smaller balances, don't have the same rules as mortgages. There was an act passed in Australia that said that no mortgage can have severance costs. So you might have a small amount of severance fees, but they won't charge you, every bit of interest for the entire 30-year term if you break the mortgage contract and you pay it back early. So that encourages you to be able to go to a new bank and say, I want to refinance my loan for a better rate, and it keeps banks competitive and keeps banks honest. But that doesn't apply to small secured loans, especially and car loans, because they can put in something called a clawback condition, which says, if you pay this loan back early, we're still going to charge you based on a formula that says, if you hadn't have repaid it back early, what is the total interest that you would have paid? And then they charge you that as an early, like a break condition. So to be able to get out of that loan, you are going to have to pay the full term of interest. So to definitely watch out for early repayment conditions on your loans. It's very difficult to avoid, as far as I can remember when I was doing my research on these myself. And so if you can, borrow from family members or peer-to-peer lending, which is when you've got some friends who have some money to invest. You want to put some, you want to borrow money from them, and they're happy to lend it to you for a small interest rate. That there's no early repayment conditions on those kind of loans. You just get the money back, and all is well. There's many predatory lenders, especially if you go to a car dealership. They'll have a lot of markup on their financing. Okay, it will seem cheap, and you look at the fine print and they say, you're only getting a 4% interest rate, but then you have to pay $200 a year in fees. And that ends up making your effective interest rate something more like 8, 9. I've even seen close to 11% interest rates, which are very, very damaging to you. And you'll end up paying a significant amount of more money over the long term. Another con that I would say is that if you take out a loan, find that you can't repay it, or something ends up happening to your ability to earn income, or your expenses blow out of proportion from where you started, struggling to pay back your debt and late repayments and failed repayments could damage your credit rating. You could end up getting into a position where you've hurt your credit so bad that later on in life, maybe five years into the future, when you go out to get a mortgage, you're finding it much more difficult because you got a black mark on your credit rating, and it pulls your credit rating down significantly. And that could be a huge problem, especially for people who want to buy businesses and want to buy houses in the next couple of years. Very, very something to be very wary of. So that's the end of the presentation, but I'd like to quickly show you what you can do on the Money Smart website. So this website's excellent for a lot of different reasons, okay? And it has some great resources for investing, for life events, credit, a huge range of things. But you can do your budgets on here to figure out what you can afford in terms of a car over the long term, how to pick a car loan, and also this is a personal loan calculator that I've shown here on the screen. I don't know if you can see, I might be able to zoom in a little bit more here. So this calculator I've set up to compare a 3-year loan to a 5-year loan, and you can see that the totals here. So this is a $15,000 loan with $60 a year in fees, paid fortnightly, and it's a 3-year versus a 5-year loan. So this is exactly the same amount of money at the same interest rate and the same repayment frequency and the same fees per year. But you can see that the 3-year loan, you end up having to only pay 1,830 extra dollars over the course of the entire loan, compared to $3,000.98 for a 5-year loan. So if you can pay the loan more quickly, if you can put aside a little bit extra money, you'll actually do yourself a great service by doing so, because paying it off in 3 versus paying it off in 8 means the $180 less in fees and a significantly less in interest over the term of the loan. Now, 7's not great. If you can borrow it better than 7, you'd be wanting to do that for sure. Borrowing against a principal residence that you've got. If you've already got a property, that's great. Take out the loan against the property and then pay out in cash. Because most property loans these days, you can get around 4%, and it makes the total repayments, $1,683. It's not actually a lot. $700 extra dollars. This really starts to balloon out of control when some people I've seen have 7-year loans and they've borrowed 30 grand because they want to get a real flash car. Even if you know that you need a more expensive car because you need things like a tray and 4-wheel drive capacity, what you want to be doing is cash financing a portion and only lending on a smaller amount for a smaller amount of years. Try and get the loan period down to 3 years. If you can do a 3-year loan, there's less chance that you'll lose your job in the long term. There's less chance that something will come up that you need to pay for and then you can't make one of your repayments, so your chance of delinquency goes down a lot on a 3-year loan. And most people can maybe know what they're going to be doing in 3 years, but have no idea what's going to happen in 5 years. 2 years can really make a lot of difference. So I'd say get the lowest rate you can, borrow the least amount of money that you can, and you don't want to be borrowing for a long period of time, which is something that you really need to consider. I would say let's point back to the golden rule at this point, that what you want to limit is the amount that you're spending. Okay, shouldn't think too much about, was this rate good enough? This rate's really good, that means I can borrow 30 grand. No, you don't do that. You pick the car that you want in your budget, and you spend just that. If you've got 30 grand, great. Cash finance it, pay 15 and invest the rest. You don't want to be spending all of everything you've got on buying a vehicle, because vehicles are terrible investments. And we as accumulators need to be consistently looking out for our future. We're not going to be able to work forever. We don't want to work forever. So you need to be putting money aside so that it can start working for you. And compound interest is a fucking wonderful thing, and it will benefit you to start putting aside that money. So I know this video has gone a bit over time, but I will put links to the Money Smart website in my post. Please click on those. Please do your research, and definitely reach out if you have any more questions about buying a vehicle. And I hope you guys have enjoyed this, and that's it for now. So thank you all for watching, and I appreciate your support. And please let me know if there's any other way I can help. Cheers.